Hello students and welcome to this explanation. This is a combination of 10 different scenarios relating to IFRS 9, and the purpose of this question is to make sure that you understand how to use your calculator, how to do the calculations, how to look for the treatment of things like discounts, premiums, transactional costs, when is it as a financial asset, when is it a financial liability. So let's read together. The first one says Bubu Limited issues 500 15% debentures at 90 Rand a debenture. The debentures mature after 10 years and there's an initial transaction cost of 3,000 Rand. They ask you what is the effective interest rate. So the first thing we want to look at is the word issues, because this means that we are working with a financial liability. And because issuance means that you issued the debentures to someone else, so now you owe them money, but they are giving you money immediately, but you will have to pay them out for the debentures that they hold at a later stage. And this will, of course, then result in you having or carrying an interest expense as well. So here there are two options, right, for financial liability. It can either be amortization or it can be fair value through profit and loss. However, this one only applies for trading. And they do not tell you that they are trading with the debentures. So we automatically know that then the default is the amortization that we need to go to. Then there's also an initial transaction cost. When there's a transaction cost and it's a financial liability, we need to take the present value minus that transaction cost. So if we go to the memo, we will then be typing the solution as follows. So for the future value, we're going to say that there are 500 debentures at 90 Rand. For the N, they have given us the timing, which is 10 years. For the present value, we need to remember now that the transaction cost needs to be deducted. So it's going to be 500 debentures times 90 Rand. And then from that, we're going to deduct the transaction cost. That was 3,000, and this should result in 42,000. Then for the payment, it will be the 500,000 debentures times the 90 Rand per debenture. And we need to apply the percentage that's attached to the debenture by the company. So in this instance, it will be 15%. Please remember that the percentage that is attached to the debenture by the company is not necessarily the same as the effective rate, aka the market rate. All right, so there we're going to say times that 15%. Then the I needs to be computed. And if I compute it on my calculator, I get 16.4%. Please remember that when you use your financial calculator, the present value needs to be typed negatively. So you need to type minus 42,000 into your calculator. Otherwise, when you calculate the rate, you say compute the I, there might be a screen message that says error. So you've not necessarily made an error, it's just the present value needs to be negatively typed unless you calculate it. All right, moving on to number 2. It says MIA Limited issues. So again, we have a financial liability. 310% corporate bonds at 100 Rand per bond. The bonds mature after 3 years. There's a transaction cost of 300 Rand. So again, we are not told that there's any trading going on, so we need to use amortization in number 2 as well. There's again a transaction cost that we need to take into account. They ask what is the effective interest rate. Right, so in this instance, we're going to say, we just copy this. Right, in this instance, we again going to need to take the transaction cost into account as it relates to the present value. So in number 2, I'm going to say that there are 300 of these bonds and they are worth 100 Rand. I don't see a premium or a discount. Then for the timing that is given, they say it's 3. For the present value, we now need to remember about the transaction cost. So it's going to be 300 times 100, and we need to minus the transaction cost of 3,000. Then there should be a payment, and the payment will be based on the 300 bonds times 100 Rand per bond times the percentage of the company that is attached to it. And I believe in this instance it was that 10%. Right, if I then compute I get to 14.33%. I'm just going to double check my calculation. Please remember to type again into your calculator. Please type the present value of 27,000 Rand negatively, just to make sure that it does not give you an error response. And then it's 14.33%, which should be the effective rate or the market-related rate. When we get to number 3, it's a bit more interesting. Number 3 says IFRS Limited purchased. So now we know the word purchase tells us we are now working with a financial asset. And if I look at this information given, it's obvious to me that I need to use amortization, the amortization method, because no information regarding fair value is given. When we have a financial asset, the options are that we can have amortization, or we can have fair value through profit and loss, or we can have fair value through OCI. But none of this contains fair value information. So here we need to use amortization as well. So they say for IFRS Limited, they purchased a financial asset, which is 1,010% debentures at 200 Rand per debenture. The debentures mature after 5 years at a discount of 10%. So this is very important. Then the market-related interest rate is 12% per year. So they've given you the effective interest rate now. They ask you what is the total present value of the debentures. All right, so let's see. We have a discount, and this discount, they say, is attached to the future value, because the debentures mature after 5 years at a discount of 10%. So when they mature, the discount will occur. Something that is important to remember about discounts and premiums are that discounts basically need factors, right? So I always explain it like this. If this is your baseline, right, the baseline is representative by number 1. Everything above this baseline is a premium, which is more. And everything beneath the baseline is discount. So if I were to give you a premium of 5%, it will be this 1 plus 5%. So the factor that you will work with is 1,05. If I say there's a discount of 5%, it's 1 minus 5%. So the factor that you work with is 95%. So that's just something that I wanted to bring under your attention. So for number 3, going back then and typing the future value, we're going to say that there's 1,000 debentures held, and we're going to times it by 200, and then the future value will be affected by the discount of 10%, so it's going to be 0.9 because it's 1 minus the 10%, which is a factor of 90% or 0.9. Right, for the timing, we were told the time in number 3, it's 5 years. Then the present value, I think we need to calculate the present value because the question asks what is the present value. So moving on to the payment, it will be the 1,000 debentures times by 200 times by the percentage attached to it by the company, which is 10%. And I get 20,000 there. And then they've given us the market-related I of 12%, so we need to compute this present value. Please note when I calculate the payment, right, I need to ignore the premium or the discount. So if there's a discount that applies to the future value or there's a premium that applies to the future value, that premium or that discount will not affect your payment. The payment will just be the number of this financial instrument, like 1,000, 2,000, 5,000, times the rand value, also known as the face value of that debenture or bond, and then times by that percentage attached to this debenture or bond by the company. Typing this into my calculator, I get 174,232.36 as my present value for required number 3. So again, please make a note that your premium and your discount. So if you have a payment, you ignore the discounts or premiums. Right. Moving on to number 4. I'm just quickly typing a layout here. Wonder if we can clear this. Seems like it. There we go. Right. Number 4. Number 4 is Shriek Limited, and it says Shriek Limited purchased 815% debentures at 100 Rand per debenture. So again, the first thing we know that this should be a financial asset. I don't see any fair value information, so we should use amortized cost. Now it says it has 815% debentures at 100 Rand per debenture. The debentures mature after 5 years at a premium of 5%, and the market-related interest rate is 11%. What is the present value of the debentures? Right, so now there's at maturity date, so in the future, when it matures, there should be a premium of 5%. So now our factor will be 1.05, because premiums increase a factor that of multiplication for the purpose of yield to maturity calculations. Right, so for number 4, we're going to say for the future value, there are 800 of these debentures. We are going to times it by 100 Rand per debenture, and then by the factor of the premium, which is 1.05. Then we have been given the time frame. They say it's after 5 years it matures. The present value we have to calculate. The interest rate related to the market was 11%. And now the payment needs to be calculated, but we should ignore any discounts or premiums. So for the payment, it's going to be the 800 debentures times the face value of 100 Rand times the interest rate attached to it by the company, which was 15%. If I type this into my calculator, I get a present value of 94,200.68 for number 4. Number 5. So for number 5, let's read together what's happening there. It's called Win-Win Limited Purchases. So this is again a financial asset. 5% corporate bonds at 200 Rand per bond. The bonds mature after 5 years at a premium of 10%. The transaction cost is 1,000 Rand. What is the effective interest rate? So now we need to sort out our thinking. We have a transaction cost and we have a premium. And the transaction cost is associated with the present value, because this is amortized cost. They've not given us any fair value information. So if it's an asset and there's initial transaction costs, we have to add it to the present value. Right, so let's see how we're going to do Win-Win. So for Win-Win, we're going to start with the future value, and that entails a premium of 10%. In other words, that's equal to 100 times by 200 Rand times by 1,05. 1,1, I beg your pardon, because it's a 10% premium. Then the N, it matures after 5 years. Then what would be the payment? The payment is going to be the future value without the premium. So that is 100 times 200 times the rate carried, which is 5%. We have to calculate the present value. So the present value now has a transaction cost associated with it. So that's going to be 100 times by 200. And this is a financial asset, so we have to add it as 1,000 Rand there. Please type the 21,000 negatively into your calculator. So if I'm going to type then, just want to check the previous one. We did use 800 times 100, yes. Right, for 5, what do I get the I to be? 22,000 future value for 5 years. 21,000 negative is the present value. Payment is 1,000. Compute I. Get 5.61%. Right. I think that's quite a nice question, because now we're starting to put different things together. Premiums, transaction costs. Now it's getting to be fun. Just double checking my calc and I still get 5.61. Right, we are on number 6. What is happening with number 6? Just want to copy this quickly, which is now 7, but we're not yet there. Right, let's read number 6. With number 6, it says Cook Limited issues 200 10% debentures at 120 Rand per debenture. The debentures mature after 5 years at a discount of 5%. The initial transaction cost is 2,000 Rand. What is the effective interest rate? Now I need to see this. It says issues. Issues. This is a financial liability. It means transaction costs need to be minused from your present value. And we have a discount at 5%, so it matures at a discount. That's something that's going to affect the future value. So let's type our figures. For number 6, it's then going to be 200 times 120 Rand times by the discount of 95%. Then we're going to have a 5-year maturity period. The payment we can calculate, but it should exclude the discount. So here I'm going to say 200 times 120 times the interest that this debenture carries, which is 10%. Then for the present value, I'm going to say this is a financial liability. So that should be 200 times 120 minus the transaction cost of 2,000. And that will give us the present value. Please remember that the present value needs to be typed negatively into your calculator. So let's see what the I is that we get to here. 22,800 future value minus 22,000 present value for 5 years at 2,400 Rand payment. Compute I, and I get an I of 11.49%. Right, moving on to number 7. Let's see what's happening in required number 7. So for number 7, it says Barbaso Limited issued 15% corporate bonds. So issued tells us financial liability. Please remember, right? Then it's 15% corporate bonds that mature in 5 years' time. The bonds are worth 200 Rand each, and 2,000 bonds are issued at a discount of 5%. The bonds are redeemable at maturity date at a premium of 2%. What is the effective interest rate? Nice. This is a very nice one. So now we have an issuance. It's issued at a discount, but it is redeemed on maturity date and it matures at a premium of 2%. And it's a financial liability. So what to do? Let's go to the memo and see. So the first thing I know is I have to go and calculate my future value. And the future value is all about the maturity date. And there's a premium of 2%. So I'm going to say there are 2,000 bonds that are issued. I need to times them by 200 Rand each. And they are going to mature at a premium of 2%, so that's 1,02. Then I have 5 years before the maturity date comes, and it's issued at a discount of 5%. So now the present value is going to be 200 times 2,000 times the discount of 5%, 0,95. Type it negatively into your calculator. The payment will be based on the future value, but without the premium. So that's going to be 2,000 times 200. 2,000 times 200 times the interest rate carried, 15%. And let's see what we get to as the interest rate. 408 future value minus 380 present value. 5 years, 60,000. Compute I get 16,84. What a nice little question. I'm just going to double check my answer. You know, the slip over the finger can cost an accountant greatly. I still get 16,84. Right, moving on to number 8. Let's see what happens in 8. It's getting exciting now. Number 8 says Fendi Limited issues. So we know it's a financial liability because it says issues. 1,012% debentures at 200 Rand. The initial cost, transaction cost is 10,000. The debentures mature after 3 years at a premium of 5%. What is the effective interest rate? So now they mature at a 5% premium. There's an initial cost. It's a financial liability. So what do we know? Well, we need to take the transaction cost and say present value minus that transaction cost. So let's type the answer to 8. So for the future value, it is the 1,000. We're going to times it by 200. We're going to times it then by the premium, 1.05. The time is given to us. It's after 3 years. Then they have given us the percentage. I just want to do the payment first. So the payment is going to be the future value without its premium. That is 1,000 times by 200 times by the interest rate carried by the debentures. That is 12%. Then the present value is going to be 1,000 times by 200 minus the transaction cost of 10,000. And please note that it's a minus because it's a financial liability. Had it been an asset, we would have to add it. Please type the 190,000, excuse me, negatively into your calculator. So let's see, 210 future value. After 3 years, minus 190 present value. 24,000 payment, compute I, and I get 15,84. 0.64. Right, we are on number 9. I'm just going to copy quickly. Right, for number 9, it says, suppose Mickey Limited purchased a financial asset and it is classified as fair value through profit or loss. All right, so now we're not going to need amortized cost. I was wrong. Let's delete. I just thought they're going to be the same pattern. What do you know? So they purchase a financial asset. It's fair value through profit or loss. The total fair value of the financial asset on the date of purchase is 1 million. The transaction cost is 50,000. What is the amount that will be recognized initially? Well, because this is fair value through profit or loss, this is going to be a separate expense. So because of this, the transaction cost is a separate expense. So the initial value of the financial asset, just see that you can see there, is 1 million. So we're going to say that the initial cost is going to be 1 million, right? And how am I going to treat this if I do the journal entries? Let's quickly talk about that. So this is the financial asset, and it is through fair value, profit or loss. So what I'm going to do is I'm going to say, well, I debit initially the financial asset, and I'm going to credit, just by the way, this isn't required, but I think it's interesting, by 1 million. And I'm going to credit the bank by 1 million. And then what am I going to do with the transaction cost? I'm going to say debit transaction cost, expense, and I'm going to credit the bank. And here, how much was the transaction costs? It was 50,000. Righty. That's how I would treat the transaction cost expense. Moving on to the last one, which is number 10. It says, if I can ever open it, suppose that Mini Limited purchased a financial asset, but now it's fair value through OCI. The fair value is 500,000. The transaction cost is 25,000. How should it be, or at what value would it be recognized? Well, now because it's through OCI, it's going to be added together. So the value is going to be 500 plus 25,000. So it will be 525. So what will the journal look like? We will only have this journal entry. Just going to copy it. And here we're going to say it's the 500 plus the 25,000. And if it's through OCI, we add the two together. So it's very important. If it's profit or loss, transaction cost is a separate expense. If it's a fair value through OCI, it's added together, and the transaction cost forms part of the cost of the financial asset. All right, so I just wanted to bring that under your attention. I hope that you have enjoyed this lecture. And then I will also be recording some videos on journal entries to follow soon. All right, have a lovely day. Bye-bye.